In this session we'll talk about adding to the probabilities, fresh versus tested levels, supply and demand ledges, compression, market maker spikes, trend trader shakeouts, and the bull and bear trap. We're going to learn some concepts that will increase your probabilities when taking a supply or demand zone trade. When choosing a zone, one of the most important factors to take into account is whether the zone is at a fresh level. The greater the number of times the zone is tested, the more likely it is to break. A fresh zone that has not yet been tested will offer the highest probability of a bounce. When a demand zone is tested, some or all of the waiting buy orders are executed, leaving less willing buyers at that level. Once all the buyers have gone, price can move through that level to the next zone. So you can see that the demand zone is being tested a number of times until it finally breaks through and demand is absorbed and there are no buyers left. So here we have the 15-minute Euro USD chart, and I'd just like to show you some fresh versus tested levels. So here we have a demand zone, and you can see that this was the first test, and there was a nice bounce off of it, and it kept on coming back and testing this demand zone until eventually it broke through. There's another example here of a supply zone. Get the rectangle tool. So this was the supply zone and can extend it all the way to here. So the first test it just missed it by a pip, same again. Second test we went deeper into the supply zone, and the third test we broke the supply zone, and then the next time we went right through. We've got another example of a demand zone over here, and price came within one pip and then bounced, and then the second time it got to the demand zone it broke through, and then we had a big move down. How price returns to a zone is another factor that will determine the success of a trade. If price makes a rounded or flagging retrace to a zone, it's more likely to bounce. One of my key filters for passing on a trade is a V or upside down V return. If you see this, it's highly likely the zone will not hold. Okay, so this is a 1 minute gold chart, and I'm going to show you the difference between a rounded retrace, a flagging retrace, and a V-shaped reversal. So this is a demand zone over here, and you can see that price, as soon as it came up, it went back down with the same speed, and it's more of a V shape. So I'll put some arrows in here. As soon as it came up, it came straight down. We can imagine an upside down V shape, and that was a low probability for buying, and it just went straight through the zone. Now I'll show you a flagging retrace. Okay, so this is a flagging retrace. I'm going to draw a demand zone. Would have been about here, and price flagged as it came back to the demand zone. So we can draw a channel to show you like this. That's the sort of retrace we want to see when taking a demand zone trade, or the opposite for a supply zone. Now let's look for a rounded retrace. Well, there's one over here. So there's a supply zone here, and price made a rounded retrace back. So there we go. As price approaches a zone, it can sometimes form mini zones or ledges along the way. These ledges can hold up price. In this diagram, a ledge has formed on the journey back to a supply zone. This little ledge could now act as a smaller demand zone and stop price falling when we sell it from supply. Now let's assume price has already tested the ledge before reaching the supply zone. The more times the better. As we've already learnt, this weakens demand by absorbing some or all of the orders, so price is much more likely to break through. So you can see price has hit the demand zone a number of times, so when it goes up to the supply zone, the demand zone is weakened and hopefully it should break through. This is the Australian dollar US dollar 15-minute chart, and there's a supply zone over here. Now, just to show you these ledges that you have to be aware of, there's one over here, so it's basically a demand zone which will be in the way. So if you were to sell at this supply zone here, even though it didn't come right back down to it, the demand zone was in the way and stopped price going any further. So until this demand zone is cleared, then price is going to bounce, and what happened is it bounced through supply and came back later and tested demand. It then made a second test of demand, and eventually it made a third test, and then eventually it broke right through. So just to be aware that these ledges can get in the way. This brings us to the very important concept of compression. By now you'll know that the more a zone is tested, the weaker it becomes. When price approaches a demand or supply zone, it will often signal its intentions in advance by testing and weakening zones or ledges along the way. When buyers or sellers are absorbed, the path is cleared for a later move. So a good analogy is a snowplow clearing a path through the snow so skiers can ski unimpeded. So in this diagram we can see demand was absorbed on the way up to supply, paving a path for a later drop. As you can see, every demand zone had been tested already, so the buyers had been absorbed, and when price hit supply, it was able to drop through all the tested demand zones. If you've been following me on Twitter, you probably know that I really do like gold. Gold is very technical and respects supply and demand zones very well. So here we have a supply zone, and price made a very nice move off of that supply. Now, how did it go so far? Well, in order to move like this, it had to eat up the pockets of demand. And we can see that there was a pocket of demand over here. Price moved up fast, came back down and absorbed the buyers, so it could later break through that area. There's also another pocket of demand over here, and it has absorbed those buyers as well. There's another pocket of demand here, and price, this little wick here, price bounced off of that, absorbed the buyers, and then was able to break through and continue its move. When we look at a bear or a bull flag, it is in fact compression. So there's a bear flag over here, and inside that bear flag there's compression going on. So let's move down to a lower time frame. This is that very same bear flag on the 15-minute chart, and inside there'll be supply and demand zones, and they'll be absorbed before price can make its way up. So there's one supply, there's another one, we've got some more supply over here, and it just carries on. There's loads of supply zones in here. There's one that hadn't been tested here, and price bounced off of it and eventually broke through, and there's demand over here. So inside this bear flag, once you drill down from the 60 minutes to 15-minute, you can see what's going on, and supply is gradually being absorbed until all the sellers have gone, and then price is able to break up. And that is why a bear or a bull flag works.